Hey there, everyone. Welcome back to our channel. If you're new here, I'm your name, and today, we're diving into a topic that can feel a bit daunting but is super important for anyone saving for retirement, required minimum distributions, or RMDs. So, grab your favorite drink, get comfortable, and let's unravel this together. Now, you might be wondering, what exactly are RMDs, and why should you care about them? Let's break it down. First things first, required minimum distributions are the amounts that the IRS requires you to withdraw from your retirement accounts once you reach a certain age. The main accounts affected by RMDs are traditional IRAs, 401s, and other similar retirement plans. As of 2023, the age at which you must start taking RMDs is 73. This means that once you turn 73, the IRS wants you to start withdrawing a minimum amount of money from these accounts every year. But why does the IRS impose these rules? Well, the primary reason is that these accounts are tax deferred, allowing your investments to grow without being taxed until you withdraw the funds. The IRS wants its share of taxes, so they require you to start taking distributions, which are then subject to income tax. Now, let's talk about how to calculate your RMD. The amount is determined using a simple formula based on your account balance and your life expectancy. Here's how it works. 1. Find your account balance on December 31st of the previous year. 2. Use the IRS Uniform Lifetime Table to find your life expectancy factor based on your age. 3. Divide your account balance by that factor to get your RMD. Let's say your traditional IRA balance on December 31st was $100,000, and according to the IRS table, your life expectancy factor at age 73 is 27.4. You would calculate your RMD like this. So, in this case, you would need to withdraw approximately $3,650 from your IRA that year. It's important to note that if you have multiple accounts, you need to calculate the RMD for each one separately, but you can take the total from any one or more of those accounts. Just remember, you must withdraw the total RMD amount by December 31st each year. Now, here's a crucial piece of information. If you fail to take your RMD, or if you take less than required, you could face a hefty penalty, a whopping 50% of the amount you should have withdrawn. That's a painful hit to your retirement savings. So, planning is key. If you're unsure about your RMDs or how to manage them, it may be beneficial to consult a financial advisor. They can help ensure you stay on track and avoid those nasty penalties. Now, let's talk about some strategies that can help you manage your RMDs effectively. One option is to consider converting some of your traditional IRA or 401 funds to a Roth IRA before you turn 73. Roth IRAs do not have RMDs during the account owner's lifetime, which can provide more flexibility in your retirement income strategy. Another strategy is to consider how your RMDs will impact your tax situation. Depending on other sources of income, your RMDs could push you into a higher tax bracket. It's worth exploring ways to minimize the tax impact, such as charitable contributions or other deductions. To sum it all up, required minimum distributions are an important aspect of retirement planning that you cannot afford to overlook. Starting at age 73, you'll need to take these distributions from your tax-deferred accounts to comply with IRS regulations. Make sure you calculate your RMD correctly, avoid penalties, and consider strategies to manage your withdrawals efficiently. Thanks for joining me today. I hope you now feel more comfortable with the concept of RMDs. If you found this video helpful, please give it a thumbs up, subscribe if you haven't already, and share it with your friends and family. And don't forget to hit that notification bell so you never miss an update. If you have any questions or topics you'd like us to cover next, drop them in the comments below. Until next time, take care and happy planning for your financial future.